All right. Assalamu alaikum wa rahmatullahi wa barakatuh. Wa maghfiratuhu. To everybody, welcome to this exclusive webinar. Jazakumullah khairan for joining us today. So, why are we gathered here today is the question that everyone is asking. Now, we are here to discuss about safe, a word that is defined by the Cambridge Dictionary as not in danger or likely to be harmed. Now, obviously, this is not an English class, right? So we're not here to just talk about safety or anything like that. This is an Islamic finance discourse. So we're going to be talking about SAFE agreements. SAFE being an acronym that stands for Simple Agreement for Future Equity. What does that mean? Well, I would tell you myself, but we are blessed to have with us today a number of individuals who have spent a good number of years, perhaps even decades, right? So they've accumulated vast experiences and are well-versed on the subject matter. They are more than happy to share their expertise on the subject matter with you and I. May Allah reward them for taking from their precious time to join us today and share their knowledge. So who are these people? Who are these people that I'm referring to? They are as follows. From Adil Advisory, we have two special individuals. We have firstly Dr. Mufti Yousuf Sultan, who is the founder and CEO of Adil Advisory. He is the co-founder of IFA Consultancy, Bangladesh, and he is as well an IOFI master trainer. Now, alongside him, we have from Adil, Brother Mohamed Mishal, who is the head of Sharia at Adil Advisory and holder of IOFI's Certified Sharia Advisor and Auditor Fellowship, known as the CSAA. He's also a PhD student at INSEF University. Now, outside of Adil Advisory, we have some other distinguished personalities as well. Firstly, we have Mr. Umar Munshi, who is the co-founder of Ethis Global, the famous venture capital builder. He's also the managing partner at HASAN VC, a Shariah-compliant venture capital and accelerator for Muslim investors. And last but not least, we have a dear brother of mine, Mr. Habeeb Gbenle, who is the CEO and co-founder of Stecs, a Nigerian-based fintech company offering ethical and interest-free digital banking services through a mobile app. He's also a holder of the ACA accounting qualification and the Certified Islamic Finance Executive Certification, known as the CIFE. All right, so that's a brief bio about our distinguished speakers. So before we jump into the event, I want to give you guys like an overview, right? Like any good thesis, like any good presentation, right? We need to know what the flow of the event is going to be. So firstly, Brother Mishal, Mohamed, right, would come in and offer us, essentially, he would lay down the theoretical foundation for what SAFE is, right? Its components, if there are any, and whatnot. Thereafter, he would highlight the Sharia concerns relating to SAFE agreements. And then he would put on the table a number of viable alternatives, right? Thereafter, we would have Brother Umar Munshi, right, who would offer us some industry insights from the venture capital perspective, right, in terms of the funding challenges, the personal experiences that he might have, and he would be willing to share with us, and as well as a commentary on the viability of the propositions made during the session earlier, right? And then we would have Brother Habeeb Gbenle, who would also offer some industry insights from the perspective of a fintech organization, right? Similarly, in terms of the funding challenges, the personal experiences, as well as commentary on the propositions made earlier. And then we would open the floor to Q&A, right? Our distinguished speakers would do their level best to address some of your concerns, because we definitely want to hear from you as well. So do take notes and, prepare your questions, inshallah. Now, of course, I did not forget our dear Mufti Yousuf Sultan, as someone, right, who has worked closely with Ethis Global, with HASAN VC, as well as Stecs. It is only appropriate that he offers the opening remarks for today's session. So without further ado, I call upon Dr. Mufti Yousuf Sultan to offer the opening remarks. Tafadhal mashkooran.
Assalamu alaikum wa rahmatullahi wa barakatuh. Alhamdulillahi rabbil alameen wa salatu wa salamu ala محمد سيد المرسلين وعلى آله وصحبه أجمعين. Thank you very much, Brother Mohamed Sano, for your kind introduction to the webinar today, as well as the fellow speakers and panelists. I welcome all of you to this wonderful webinar today, titled Simple Agreement for Future Equity for Safe, Sharia Concerns, Industry Insights, and Viable Alternatives. I welcome all of our esteemed speakers, panelists, particularly Mr. Umar Munshi, who I have worked for a long time at Ethis Global as well. And until now, we are their shared advisor for Ethis Group. We welcome Mr. Gbenle Habeeb from Stecs, as well as our very own Brother Mishal, to present about the SAFE agreement, the Sharia concerns that we have, and the alternatives that other advisory we have researched on, worked on, and we have been advising on. The webinar is very important for two reasons. First and foremost, to understand the Sharia concerns as well as alternative for SAFE. And why is it important? As Muslims, we know that Sharia compliance in all aspects of our life is an obligation, particularly when it comes to our financial transactions, business activities, even the fundings and investments that we have or we make with the other ventures. All of these come under the broader umbrella of Sharia compliance requirements by the Sharia, by Allah subhanahu wa ta'ala, by the Sharia himself. As we know, Allah subhanahu wa ta'ala has prohibited riba. He profoundly mentioned, فَإِن لَمْ تَفْعَلُوا فَإِذَنُوا بِحَرْبٍ مِّنَ اللَّهِ وَرَسُولِهِ. If you don't get rid of riba, be prepared of war against Allah and His Prophet sallallahu alayhi wa sallam. And riba is just one, but Allah mentioned few other things in the Quran as well, including maisir, which is gambling. And then in Sunnah, Rasulullah sallallahu alayhi wa sallam mentioned other things as well. And based on these premises, until today, the Sharia scholars have been guiding us in our banking, insurance, capital markets, sukuk, for example, and all of the activities, including the fintech, BNPL, and so on and so forth. When it comes to startups, we know that founders have been struggling, finding Sharia-compliant funds. And when it comes to Sharia-compliant funds, one challenge is, of course, finding Muslim VCs, Muslim funders. Even though, alhamdulillah, we have many angel investors around the globe, maybe we are not so well connected, and something that HASAN VC, with the leadership of Brother Umar Munshi and many others, are now, alhamdulillah, coming forward to fill the gap. But on one hand, we have the challenge. On the other hand, we have challenge in lack of instruments that are well known to the investors, that are highly accepted within the investors community as well as the startup community. One instrument which has become quite popular over the last few years is known as Simple Agreement for Future Equity of SAFE. And indeed, it also has some Sharia concerns which are rectifiable, which we can work on, which we can reproduce in a way that is Sharia compliant, as well as it serves the interest of the investors as well as the startup founders. So the webinar today is meant to give us that insight. And I'm happy to share that at Adil Advisory, alhamdulillah, we are registered and licensed with the Securities Commission Malaysia, with the Labuan Financial Services Authority. We're also partner and training partner exam center for IOP. So with the advantage that we have in Malaysia as well as global, we hope that the alternatives that we provide are in compliance with the requirements of the Malaysian regulations, as well as international trade standards, bodies, for example, IOP and others. So with that, I won't take much long. I would like to conclude my opening remarks. I would like to thank all of you for joining the session. Please take your notes. And if you have any questions, please ask in the chat box. You can also ask direct questions during our Q&A part at the very end, inshallah. And we hope this session today will be a wonderful value addition for entire startup and VC and investors community. With that, Jazakumullah khairan. Assalamu alaikum wa rahmatullahi wa barakatuh.
وعليكم السلام ورحمة الله وبركاته. جزاك الله خيرا كثيرا, Mufti Yousuf Sultan. I think, as Mufti mentioned, without further ado, let's dive straight into the subject matter. Let's hear from the experts, the experienced individuals themselves. So to start off the discussion, I want to invite Mr. or brother, right, whichever you prefer, Akhi, Mohamed Mishal, right? Mishal is Sheikh Mishal over here with us? Sheikh Mishal?
No.
Okay, Sheikh Mishal is over here. Jamie. Okay, so Mishal, thank you for joining us today. Right? As someone, right, yourselves, as someone who has offered Sharia advisory, right, and consultancy services to institutions across the Islamic finance industry, right? Could you give us an overview of what SAFE agreements are, right? We hear the words, you know, everyone has seen the posters, it's written SAFE agreements, Sharia concerns, this and that, but can you tell us really what SAFE agreements are, right? And upon doing so, could you tell us what are some of the Sharia concerns, if any, right? And then we would hope that you can end it off with some plausible or viable alternatives if there exists as well, right? Pass the floor over to you. تفضل.
طيب السلام عليكم ورحمة الله وبركاته everyone. بسم الله الرحمن الرحيم. الحمد لله رب العالمين. اللهم صل على سيدنا محمد النبي الأمين وعلى آله وصحبه أجمعين. First of all, we thank Allah who has gathered us here in a session where we seek knowledge, we seek to know the rulings of Allah on our transactions. And secondly, I would like to thank and to express my my feelings of being humbled to share the stage, especially with the like of Mr. Umar Munshi and Dr. Mufti Yousuf Sultan. I'm pleased, of course, to share it with my brothers, Brother Habeeb and Brother Sano. Thank you, everyone. I wouldn't take much in the introductory remarks. I will dive straight into the discussions. If you allow me, I've prepared the presentation. So generally, the presentation will firstly highlight what is SAFE. It will be a refresher on what is SAFE for those who are familiar with SAFE. And for those who are less familiar with SAFE, it will bring you up to pace. So we simplify the concepts of SAFE, and then we move into Sharia discussions on what are the issues in SAFE and how can we fix them. And we also analyze some of the fixes offered in the industry or we have faced during our experience in the industry. طيب, Bismillah. So a refresher on SAFE, we will discuss what is SAFE, where it originated from, who created it, why did we have SAFE, why not just normal equity, when do investors get shares, how do they calculate the price of shares, and which price is used. So where did SAFE come from and who created it? It started in Silicon Valley, where many startups are there, and it was created by a famous startup accelerator, Y Combinator, in 2013, and there was an updated version in 2018. What is SAFE? It's a simple agreement for future equity. It's an agreement where the investors will channel the money and will only get equity in the future upon the occurrence of one of specified events. Why not issuing shares now? I mean, why not issuing shares upon the wiring of the investments? Because of two main reasons. The first one is that the two parties, the founders and the investors, could not and cannot agree on a valuation. We have come across startups that the investors would value it at 2 million and the founder would value it at 20 million. And if these two parties virtually they can't agree on any valuation, the investment cannot happen. SAFE enabled investment to happen. So they can have a valuation cap, and then they will have the down round protection. We will see, I mean, these terms in the future, but basically it defers the question of valuation. We don't need to agree on a valuation now. We can just take the money, invest it, operate, and then in the future, once the numbers are more solid, once we have more users, more revenue, we can agree on a valuation better. And then there will be institutional investors or more experienced investors who are coming at a fixed valuation in the future to solve this valuation dispute. Another reason that we saw SAFE is used for is because it's of speed and costs, as well as flexibility. Speed is SAFE. SAFE is about 5-page document. It's not very long. It doesn't have many terms. The founders and the investors agree on just few terms, the valuation cap, the investment amount, and that would be it. Other terms are standardized. It's flexible. You don't have to agree on a valuation cap for all investors. One valuation cap for all investors. You can agree on a valuation cap for one investor, another valuation cap for another investor, and so on. When does the investor receive shares? Now, remember, we mentioned that SAFE, you wire the money, you receive shares in the future. When does that happen? Upon the occurrence of one of the trigger events that are detailed in the SAFE agreement. First one is equity financing. Equity financing is when the company raises funds at a fixed valuation. And that would be typically, for those who are familiar with this, with startup culture, it would be Series A fundraising. Another trigger event would be a liquidity event. Liquidity event is defined in SAFE agreement as an event that would cause a change of control. And basically, I mean, more familiar term would be in situations of mergers and acquisitions. Its liquidity event is also, one of the liquidity events is also an IPO, initial public offering. Another liquidity event is direct listing, which is listing of the existing shares in a public exchange, slightly different from IPO. The last trigger events would be a dissolution event, which basically when the company winds up or shut down, or the operations are shut down, or the creditors take over the company to get back whatever they can claw back from the company. So these are the 3 trigger events. If one of these 3 trigger events take place, then shares or proceeds in brackets will be received by the SAFE investors. How is the share price determined for SAFE investors? Firstly, the value at trigger. So basically, the trigger event would give us a value. Let's say the company winds up and we have proceeds. Those proceeds would give us a value of the company. The company raises funds, a Series A funds, or a priced round, generally, to be more general and accurate. A priced round, a round where the valuation of the company is fixed and determined. Then we know the valuation of the company based on this trigger event. Also in mergers and acquisitions, on all of these events, we will have a fixed value for the company. Now, that alone would not determine the SAFE, the share price for the SAFE investors. The second determinant would be the SAFE terms. And what are the SAFE terms that would determine the SAFE price? We have 3 versions of SAFE generally. Not generally, actually. On Y Combinator, if you go to the website, you will have 3 versions of SAFE. The first one is SAFE with valuation and without discount. The second one is SAFE with discount and without valuation. And the third one is termed as MFN, or most favored nation. What are these? The first one is when we have a SAFE with discount and without valuation, right? Valuation cap, then the price per share determined in the value at trigger will be multiplied by discount rate to get to the share price, or we have the invested amount. And this is based on the liquidation preference, something that we will discuss in details. The second determinant, or the second term that would determine the share price, is the valuation cap. And it's the price per share as per valuation cap over company capitalization. What is company capitalization? Company capitalization is refers to all of the existing shares in the company, ordinary shareholders like founder shares, and options in the company, like employee stock option pool, and promised options and issued options. All of these options will be included in the company capitalization, as well as the shares that will be issued for the SAFE investor. So that would amount to company capitalization, the total shares in the company, or the shares that would the valuation cap would be divided over, and we would get, based on that, a price per share for the SAFE investors. Or again, the invested amount. Why do we have the invested amount again? Because of liquidation preference, something that we will discuss when we discuss Sharia issues. MFN is basically, you don't get discount, you don't get valuation cap, you get you get a term in the agreement, in the safe note, that says that when the company raises funds, raises more safe agreements in the future, they will notify you. And if you like the terms, you can adopt these terms. And this would be applicable only once. You can adopt only one time. If you adopt terms of a future safe investment, then this would apply to you. So we will not be discussing MFN because we will be discussing discount and valuation cap and see what are the Sharia issues that relate to them. Otherwise, if MFN doesn't adopt anything until the trigger event takes place, then they will just take the price of the new investors, or again, the invested amount, because we have a liquidation preference. Which price is used? Now, if you've noticed, we have an investment amount and we have the price that is determined based on the discount or valuation cap. And that price, we would term it now for our discussion as safe price. And this is what is termed in the agreement. So it is in valuation cap, we call it safe price. In discount price, in discount version, we call it discount price. But for both of them, we will term it as safe price. So in dissolution events, when the company winds up and other dissolution events, the investor would always get the invested amount. The invested amount is known in the safe agreement as the purchase price, which is the money that is invested. Let's say you invest 1 million and then there's a dissolution event, you'll get the 1 million. You will have a liquidation preference over ordinary shareholders. Other prices in other events, such as equity financing or IPO or merger and acquisitions, basically what you mentioned as liquidity events or equity financing, you will have, the safe investor will have the more advantageous price out of the safe price, the invested amount, or new equity price. When we raise new equity financing, if the new equity price is lower than the safe price, then the investor would take that price, will convert at a lower price, and as a result will get higher number of shares and higher equity, of course. Now we move on to Sharia discussion. The first question is, safe note a debt instrument or an equity instrument? In our view, we see it as an instrument of, it's a partnership contract. It doesn't give you shares per se, so it is more in the category of equity instrument and not a debt instrument. Why is that? Because debt instrument, when we talk about debt specifically here, we're talking about a loan agreement where you transfer. Let me define it from Sharia technical point of view. A loan is defined as transfer of the ownership of an asset with the obligation to repay an identical asset in the future. Not the same asset, an identical asset. So in simple terms, you transfer 1 million, you will have the obligation as a borrower to transfer back to repay 1 million in the future. That would constitute a loan agreement. When we apply this to safe, we don't see the repayment obligation as a primary obligation on the safe. The safe note doesn't have any repayment obligation as a primary obligation. You might have situations where you will get back your investment amount, but it's not a primary obligation. Let's say, I mean, just to simplify it, what we mean by not a primary obligation. Let's say you purchase something and you paid the price for it. Now, when you pay the price, there is no primary obligation to repay the price to you by the seller. However, in case you have an option to terminate the contract within 3 months, you have khiyar shart, or you have khiyar al-aib, you have the option to return the item if it was defective within a certain time frame. When you return that item, you will get back your money. You will get your sale price repaid. Is that repayment a primary obligation? No, it is not. And in this case, in this sense, we don't view the sale agreement as a loan agreement. Similarly, we don't see repayment in safe note as a primary obligation. It might happen, but it's not a primary obligation, and that's why we don't see it as a loan. We don't see it as a debt instrument. Other features, such as not having a maturity date in safe note. Safe note doesn't have a maturity date, for those who are unfamiliar with the details of the safe note. And it doesn't have interest. It doesn't pay interest. Safe note by default doesn't pay interest. Now, the lack of these two features is not a defining features of loan agreement, because al-qard al-hasan, an interest-free loan in Islamic finance, doesn't necessarily have an interest, or it must not have an interest, and it may not have a maturity date, a repayment date. So the lack of these features does not make any instrument or does not preclude the possibility of SAFE being a debt instrument. But the first one is the one that made us think that SAFE note is not a loan agreement. However, if it's a loan, then the features of discount and valuation cap constitutes an additional benefit, a contractual additional benefit over and on top of the loan amount, and that would amount to riba based on this قاعدة, on this maxim. كل قرض جر نفعا فهو ربا. جر نفعا فهو ربا. Every loan agreement that attracts benefit, contractual benefit to be more precise, then it would be riba. It is a partnership agreement, as I mentioned. We view it as a partnership agreement. However, even though it's a partnership agreement, we still need to validate it from Sharia perspective. Now, before we analyze the features of SAFE against the rulings of partnership agreements, I would like to stress on two defining Sharia principles on partnership agreements. I cannot stress more on these two principles. If you master, whether you're an investor or you're a Sharia advisor or you're a student, if you truly understand and deeply and firmly understand these two principles, you'd be able to solve many of the issues that you will find in investment agreements in general, not just in this SAFE note. And these two principles are, firstly, losses must be shared according to capital contribution ratio. Losses must be shared according to capital contribution ratio. There cannot be any agreement to alter that ruling, that principle. So you can't agree on a loss sharing ratio that is different from capital contribution ratio. It must be the same. Secondly, let me read, the basis for this. This is mentioned in IOFI, and it is well known. In IOFI, Sharia Standards number 12 on Sharika, on partnership contracts, clause 3154 states, it is a requirement that the proportions of losses borne by partners be commensurate with the proportions of their contributions to the shirka or to the sharika capital. So this is the first principle. The second principle is that profits must be shared. There must any condition that would result in the possibility of one of the partners being completely deprived from profit while the other partner enjoys some of the profit would be an invalid condition. In other words, there must be no deprivation of profit. If there is a profit, all partners must take at least even a small portion of that profit. There can't be a condition that would result in one partner taking profit and another partner not taking any profit at all. And that is based on IOFI, Sharia Standards number 12, again, on Sharika, clause 3157. It states, it is not permitted that the conditions or modes of profit allocation in a Sharika contract includes any clause or condition that may result, okay? I will go back and stress on may result instead of that would result or that will result in the probable violation of the principle of sharing profit. Why do we say may result? And why do I want to stress on may result? Because in many situations, including the review that we will conduct now, in actual terms, when the investment happens, all of the partners will share some of the profits. However, even if the condition is invalid according to this principle. However, if we analyze this, the probability of one situation or scenario that would result in a violation, that may result in violation of this principle, you would find it applicable in many situations. So whenever we analyze or review a condition that relates to allocation of profit, if you can come up with a scenario, even if it's improbable, if you can come up with a scenario where one partner would get profit and the other partner would not get profit, then such condition would be considered invalid. Now, the main issue of SAFE, we view it as liquidation preference. However, it stems from a deeper issue. It stems from the lack of knowledge on what constitutes capital and what constitutes profit. So it's not just merely a liquidation preference, it's a liquidation preference that is based on lack of knowledge, that is based on ambiguity that relates to capital contribution ratio. When does it apply? Applies in all cases of winding up and in some of the liquidity events. Remember when we mentioned which price do we use, and we mentioned that, for example, safe price or invested amount or purchase price. So that purchase price, that invested amount in safe note, if someone is familiar with the legal agreement, it's termed as the cash out amount. So in winding up, you will find that the only price is cash out amount. In liquidity events, you will find that you will get the option to choose as a safe investor to choose between the cash out amount or another price, a safe price or a liquidity price. So liquidity preference is applicable in all of safe versions. Liquidation preference is present in all safe versions, and it applies in certain situations. Why isn't it liquidation preference allowed? I'm not sure if we can take participation, but for the interest of time, basically because it violates the first principle we mentioned. Losses would not be shared according to capital contribution ratio. Let's give a brief example. Zaid invests 1 million at 10 million valuation of a company. So Zaid is an owner of 10%. Zaid gets a liquidation preference, and the company winds up, and it winds up, and the proceeds of the winding up is only 4 million. If Zaid gets, based on his liquidation preference, he will get 1 million first, and then the other shareholders will get the remainder. Now, 1 million out of 4 million is 25%. It's not according to the capital contribution ratio, and that's why basically liquidation preference is not allowed, and it can't be altered by agreement. You can't say that we agreed that you will take, for example, liquidation preference despite not being according to your capital contribution ratio. This is a ruling that cannot be altered by agreement. Does removing liquidation preference solve the issue? And specifically this question or this slide, I would like to bring your attention to something that is practiced, that we have seen in the industry, that some of the users of the safe investment, they would remove the clauses that would give liquidation preference, and they would assume that they have solved the issue of safe. However, specifically, that would apply in preference shares, normal preference shares, preferred equity. If you remove the liquidation preference, you would be left with the profit distribution preference, but you would solve the liquidation issue, once and for all. However, in safe context, this doesn't apply. This doesn't solve the issue. Why is that? Because as I mentioned, it is the liquidation preference, but it stems from a deeper problem, which is the lack of knowledge on what constitutes capital. And AOFI, also Sharia standard number 12, Sharika 3123, clause 3123 states the share of each partner in the capital should be determined. Now, if you go and see these safe notes that remove the liquidation preference to address the Sharia issue, which is a great attempt to move towards the Sharia compliance, you would not find any basis or any clause that would determine what constitutes capital, the capital contribution of each of the partners, because you don't issue equity. Let me give you a context. When you buy equity, normal equity, ordinary shares, you will get an equity percentage in the company. Let's say, for simplicity, a company with 10 million shares, outstanding shares. If you buy 1 million of these shares, you will own 10% of the company. And when you own 10%, we know what's your capital contribution. Your capital contribution is 10%. However, in safe investment, you don't own any equity, and there is no way to determine what constitutes capital as it is. But we will see how we can address this. Now, one way to address this is, can valuation cap serve as basis for the capital contribution ratio? CCR is an acronym for capital contribution ratio. Can we use the valuation cap as the basis for this capital contribution ratio? The answer is yes, if it is the only price. Remember, in one of the introductory slides, we mentioned that which price we would use for SAFE. And we mentioned 3 different prices. First one is the invested amount, the purchase price. And that is removed now by removing the liquidation preference. I assume that if wants to remove that, remove the liquidation preference, they will remove the cash out amount from all of the SAFE notes. Secondly, we have the SAFE price. The SAFE price is determined by the valuation cap, or the discount price, which is determined by the discount rate. We will stick that. That would be the second possible price. The third one is the price of future equity, and this is something that you can say that SAFE has an embedded down round protection. What is down round protection? This is in the startup culture or the startup environment. When investors come, because valuation is always a challenging question in startup investments. In some agreements, they will have an additional clause or additional note or additional letter that would give investors a down round protection. What does it mean? Let's say I invested 1 million in a company, and we agreed with the investor, that with the founder, that the valuation of the company is 10 million. So now I own 10%. However, I'm not very sure that this is the true worth of the company, and I'm not sure that and I'm afraid that in the future, if more experienced investors came in and valued the company, they would have they would value it as much lower than 10 million. So what I would request for is a down round protection. What does that mean? It means that in the future, if an investor comes in and you as a founder and the new investor agreed on a valuation that is lower than the valuation you agreed with me, you agreed on a valuation lower than 10 million, then my investment would convert again at the lower valuation. So let's say the new investor, for simplicity, you agreed with him on 5 million valuation, on the valuation of 5 million. Now my 1 million, which was worth 10% initially, with the down round protection, my 1 million now would amount to 20%. I would convert at the new valuation, the lower valuation. SAFE doesn't have to have the down round protection letter or clause. It is embedded in the agreement. Why? Because in the agreement, if in the first page, when you go to equity financing, they will tell you that the SAFE investor will convert at the greater of number of shares, that is the greater of SAFE number of shares that is based on SAFE price, or the new equity price. So what this means is that, let's say in the previous example, as I mentioned, instead of getting 10% immediately, we agree on a valuation cap of 10%. And we agree that the valuation will be determined in future equity financing. And the future equity financing comes in and it is lower than 10%, I will, as a SAFE investor, convert at the lower valuation. And this means that I have a down round protection. Now, what is the issue with that? It means that I will get higher equity than I would have gotten if I have used the valuation cap. And again, what does that mean in the context of Sharia? It means that if you take the valuation cap as basis for the capital contribution ratio, then the investor would have to bear the losses according to it. So the future valuation would amount to a loss, and I must take that loss. I must maintain my 10%. I can't increase it, because if I increase it, I'm not sharing losses. The losses are all absorbed by the founders. And if you see that we are following, I mean, just a side note, we are following Sharia principles here. But if you analyze it from economic perspective and from equity perspective, you will find that it's fairer. Because let's say you raise fund just in the in the period before COVID-19, which was a very unique period where money was flowing unreasonably towards startup companies. And during COVID, you know how things has changed, and after COVID, we came into what is termed as the startup winter, and valuation became more realistic than they were before. Now, if you are a founder and you have raised funds during that period, and now you are hit with coronavirus, with COVID-19, and your operations are stalled, and you had to maintain the life of the company, you had to raise fund on a lower valuation. You will not be only suffering from, I mean, what businesses are suffering, what normal businesses are suffering because of COVID-19 and because of the economic downturn. You'd be suffering from this down round protection. Now you have to compensate your previous investors without mismanaging or without misrepresenting anything, just because of this clause. And this is why it is unfair and it is not Sharia compliant. So again, can valuation cap serve as basis for CSR? Yes, if it's the only price. What does that mean? It means that you go to the safe note, the agreement, and you remove the possibility of converting at a price other than the safe price. Remember, we have the safe price and we have the new equity price. So we say that you will always convert at the valuation cap. So even if the future investor, if the equity financing comes in and says that your company is worth 8 million and you raise funds, you raise Series A at 8 million, you would still, as a safe investor who want to apply this, you would still convert at the valuation cap, 10 million. Now, there are two challenges with this fix. The first one is that if you have used SAFE just for simplicity and flexibility, then that fix would not be very challenging, because you agree on a valuation with the investor and they accept the risk. It would be very close to just selling ordinary shares. But if you do, if you used SAFE to solve the valuation mystery, to be able to take money without having to determine a valuation, then that would not be applicable. That would not be possible. I mean, to apply this fix, to have just one price. The second challenge is that we have a version of SAFE that is SAFE without valuation cap. Then what would be the basis for the capital contribution ratio? How can we address these two challenges? At the beginning, the parties, the investor and the founder, has to determine what constitutes capital, and we will mention how they can do so practically. And again, they will have to agree on a way to share the profit. We will also detail that. Without immediate issuance of equity and without immediate determination of price of equity. Why is that? Because we don't want to fix the valuation. We don't want to fix the valuation in a way that would significantly dilute the founders, or that would repel investors from coming in, because if it's too high or it's too low. So if we don't issue equity, we still have room to play with the outcome of the investment when it matures. I mean, what I mean by when it matures, when the company matures and the valuation becomes easier to determine. What is the effect of knowing what constitutes capital? The simple answer is that we would be able to apply the first principle. We would be able to have a valid partnership agreement. But it enables us to determine what amounts to a loss and what amounts to a profit. How a profit, these are general principles. I'll go through them quickly for the interest of time. How are profits and losses shared in Islamic finance? Losses, this is a recap actually of what we mentioned in the first two principles. Losses are shared according to capital contribution and they can't be altered by agreement. Profits are shared according to agreed upon ratio, and it's flexible. You might have different profit sharing ratio for different tiers of profit. So for the first 10 million, let's say, or 10K, the profit will be 50-50 between the two partners, but the amount above it will be 90-10, and so on. You will have different variations. However, it is guided by one control. What is it? whatever variation that you have, whatever condition that you have that relates to profit sharing or profit allocation, it must not lead to a situation where one partner receives profit in exclusion of the other. How do we determine what constitutes capital? Now we go practically into the solution. Now, I want to have a valid SAFE agreement. How can I determine the capital if I don't want to take this one, this solution? Sorry, yeah, this one, using the valuation cap as the final valuation. If I can't or I don't want to take that, how can I determine capital? What constitutes capital? What we mentioned is that we can agree, or the two parties agree on conservative valuation method to value the company. The simplest is a book value, but they can agree on other methods such as cost to duplicate, which is, for example, how much would it cost any person to duplicate the company in its current status, or the liquidation value of that. If we liquidate all the assets of the company or the startup, how much value would we get? So we can use any of these valuation method to value the capital of the company, and that would be our basis to know the capital contribution of all the partners. Now, why would founders agree to this? Why would founders agree on a very low valuation method or valuation of a company, of their company? Simply because they are not issuing equity based on this value. This value would be used to determine the loss sharing ratio. And in fact, for founders, this is more advantageous than having a liquidation preference. Why? Because if we determine that, let's say, in the previous example that I mentioned, you invested 1 million at a 10 million valuation cap, and let's say the book value of that company was only 1 million pre-money. Before that 1 million, your 1 million, the invested amount was wired. This means that the capital contribution ratio of the two partners, the founder and the investor, would be 50-50. Why? Because the founders contributed 1 million, the book value of the company, and the investor contributed 1 million, the invested amount. What does that mean for the founders? For the founders, it doesn't mean that they have to sell 50% of the company. So they are safe from this, and no sane founders would do that in seed round. Secondly, why is it more advantageous for the founders? The other alternative is to have a liquidation preference if you don't have a capital contribution ratio. And let's assume that, let's see, okay, it's not here, but you'll see it in the future, but I can mention it now. Let's say that the company is liquidated and you ended up, as a founder, you ended up with 1.5 million in proceeds. In normal SAFE, in conventional SAFE, what would happen? The SAFE, after paying all the creditors, the SAFE investor would get the 1 million first, and then the founders and other ordinary shareholders will share the remainder, or the 500,000, remaining 500,000 on pro rata basis. In our version, or in this fix, if we apply this fix, we decided, or we concluded that the capital contribution ratio is 50-50, because the book value is 1 million and the investment amount is 1 million. And now we ended up with a situation where the company is acquired or winds up and the proceeds are only 1.5. The SAFE investor would only get 50% of that. Why? Because he has to share losses according to capital contribution ratio. The investor and other shareholders will share the other 750,000. And as you see, as a founder, you get more in situations of loss, and you don't lose ownership of the company. Okay, let's address, maybe investors would be concerned now. Why would investors agree to this? It's something that we addressed in a comment slide, but let's address it now to clear your thoughts. Why would investors agree to a capital contribution ratio? Well, it is less advantageous for the investor in cases where the company is not doing well. The company is in the example, the company is acquired for less than it is what was the book value when the investment came in. it means that the company is either liquidated or it's not liquidated, like it's shut down, it completely halted the operations, or the company is acquired for like purposes, for different purposes, but it's acquired for a low value considering the numbers that we have shared. As an investor in a startup, in a startup environment, although this is less advantageous to you, normally what would happen if companies, if startups are not doing well, they end up, they are liquidated and they shut down, and usually they will have more debt than proceeds. They will not have any proceeds at all. So even though you have these terms, but the effect of this term is not really material in this context. In this context, it's not material because you would rarely face a situation where you'd really have to share losses. I mean, you would have to share anything. If there's a loss, usually it's a below zero. It's a negative amount. What constitutes profit in Islamic finance? Any amount that is over and above the initial capital contribution of all partners. In our previous example, anything above 2 million would amount to a profit. And such amount can be cash or mere value or capital appreciation. Doesn't have to, I mean, we don't have to sell all the assets to determine profit. Remember, we have actual liquidation of company, or we have conservative liquidation or valuation. And how do we determine if there's a profit? I just mentioned that, actual or conservative liquidation, constructive liquidation. In the context of SAFE, a future pre-money valuation that is higher than the capital contribution of all partners constitutes profit, which we just mentioned. If you get a future pre-money valuation based on any of the three trigger events that is higher than 2 million in the previous example, then that amount above the 2 million would constitute profit. Do shareholders in general agree on a profit sharing ratio? Remember, we mentioned that when you buy ordinary shares, we're talking about ordinary shares now, just to ease you into what would be the situation in SAFE. In ordinary shares, if you buy shares and you own 0.5 of the company, and the company declares dividend, you would receive 0.5% of the total dividends declared by the company. What does that mean? It means that the profit sharing ratio for you is 0.5. And do the company or do the founders or the lawyers have to expressly mention that the profit sharing ratio is 0.5? No. Why? Because it became a custom, arf, that whatever you own in the company would be your profit sharing ratio. If you own 10%, you would get 10% of the profit. You would share 10%. If you own 0.5, you get 0.5, and so on. Is that required from Sharia perspective? Not according to AYOFI. According to AYOFI, you can own 0.5, but you can have a different profit share ratio. You can have 1%, or you can have 0.1. Depends on the agreement. How is the profit share ratio determined in SAFE? Generally, it's the investment amount versus the valuation cap. This is for the profit share ratio above, for the profit above the valuation cap. So anything above 10 million, in our previous example, again, for example, investor invests 1 million with 10 million valuation cap, the profit sharing ratio for any amount above 10 million is 10% for the investor and 90% for the others. Now focus on this. We mentioned the profit sharing ratio for any amount above 10 million. It means that for the amount below 10 million, we still don't know what is the profit sharing ratio. But for the amount above 10 million, above the valuation cap, the profit sharing ratio would be calculated by this formula: investment amount above or divided over the valuation cap. This applies to both conventional SAFE and our alternative. This is not an issue in conventional SAFE, so we don't have to fix it. Again, we don't have to call it a profit sharing ratio as long as it serves the same function. In Sharia, we have the famous, beautiful maxim: العبرة في العقود للمقاصد والمعاني لا للألفاظ والمباني. The paramount consideration in contracts is to the essence and not to the form and not to the basically to the use of words. How is valuation cap determined? This is technical. I will not spend much time in it, but for example, founders would determine what would be the valuation cap based on what they are willing to give as equity for the for the coming investments. So let's say I own a company and I'm willing to give 10% equity for 1 million investment. This is 1 million investments. Then by reverse calculation, you will know that the valuation cap that you would accept for this investment, 10 million. And why would you accept 10 million as a valuation cap? Because as a founder, I expect to reach this 10 million valuation in the next round. And based on that, when I reach to that round, I'm willing to give, let's say, 10% equity until the next financing round or fundraising. And for that, I'm willing to accept 10% dilution. What if the future valuation is below the valuation cap? Remember, I mentioned that the profit sharing ratio applies to the profit that is above 10 million. But what if the future valuation is below the valuation cap? Conventionally, what happens is that you'll convert at the lower valuation. If it's an equity financing, you'll convert at the price of the equity financing. Let's say, as I mentioned previously, the next round or the equity financing came in at a valuation of 5 million or 8 million or 9 million, then you would convert at such valuation. And if you have a discount, if it's a safe version with a discount and a valuation cap, then you would apply also the discount. Or in liquidity events, you will get, if the future valuation is below the valuation cap, you will get the invested amount based on liquidation preference, if that was still maintained. So in this scenario, there are two possibilities. It is also below the capital contribution of all partners, below 2 million in our example. It is above that, above 2 million, below 10 million. So this is the example. A valuation cap of 10 million, capital contribution of 2 million. The future valuation, let's say liquidation, the company is liquidated and you get the proceeds of 400K. In conventional SAFE, the SAFE investor would get all of that amount. The founders would get 0. In our modified version, they will get 50%. They will share 50-50. So the investors will take 200K and the other, the founders and other ordinary shareholders will take the other 200K. So far, everything we have explained, this is the first of two main deviations of SAFEi. SAFEi is our alternative from conventional SAFE. All of the discussion is about Sharia principles, but when it comes to deviation from the conventional SAFE of what is the norm in the industry, this is the first of the two main deviations. And you see when it applies when the future valuation is below the capital contribution. Why would investors agree to this? We mentioned because it's not crucial in startup context, as the chances of having any proceeds at all are slim, and because it's more equitable. Now, the other situation, we mentioned that it's between the two, above the capital contribution, below the valuation cap. The future valuation is 8 million. They would convert at the lower valuation. And if there's discount, then the discount will apply. And as you see here, if they convert at the valuation cap, they would get 10%, but applying the discount and the lower valuation, they get 13.5% equity. However, discount rate is not an acceptable method of sharing profit in Islamic finance. Why is that? We mentioned that the way to allocate profit is very flexible in Islamic finance, provided that you avoid violating the control that we mentioned, the second control, which is there is no probability of one of the partners being completely deprived of profit if profit is earned. Why isn't discount rate acceptable? Because of what I mentioned. Let me give you an example. So a condition is invalid if it would result, even theoretically, in one partner enjoying profit in exclusion of another. Let's give an example. Let's say that it's 10-20, the same example that we had before, 20% discount. And let's take the second scenario for the interest of time. The company is acquired for 1.1 million. Okay. The capital contribution rate, the total capital contribution is 1 million. here it's mentioned here, agree to a CCR of 1090 for an investment of 100K. It means that 100K, 10%, and 900K is the capital contribution of the founders, is valued as such. Let's say the book value is 900K, and the investor came in with 100K, and the CCR is 1090. Now, if the company is acquired at 1.1 million, the fair market price for ordinary shares would be $1.01 per share. The safe investors' share price would be 80% times, so they have 20% discount. So 80% times 1.01. The share price for the safe investors with discount rate, and we are discussing why discount is not allowed, is not a right, or not acceptable way of sharing profit. If we use that share price, multiplying it by the investment amount of 100K, you'll get this number of shares, and it would amount to 11% of equity valued at 121,000. Meaning that the capital gain of 10K, this should be 1.10, not 1.1, 1.01, sorry, 1.01. So the profit, let me simplify it. The profit in this situation was merely 10K. Remember, we are discussing we are trying to analyze or test if the condition or the way to share profit based on discount rate would hold against this this principle. And we assume that the profit was merely 10K. And we, after calculating the safe price based on the discount price, the investor would get 121K. It means that the investor not only got the 10K of profit, the investor received more from the capital contribution. It means that the founders will be receiving less than 900K. They will be making losses, while the investor is making a profit of 21.1K, which violates the second principle, no deprivation of profit. However, discount rate also violates the first principle as well. And this is the example here. So discount rate, we can't accept it in Islamic finance and in safe notes. What is the alternative? To apply a profit sharing ratio for the amount above the total capital contribution and below the valuation cap, as that one is implicitly set. So this is the second of the two main deviations of SAFEi from conventional safe. So the first one we mentioned is when there's loss, it will be shared according to capital contribution ratio. But for investments that for future valuation that is above the capital contribution, amounting to 6 million here in profit, but below the valuation cap. Remember, the valuation cap, we use it as a determinant of the profit sharing ratio for profit above 10 million. So for this amount, for this portion of profit that is between the capital contribution and valuation cap, we need to have another profit sharing ratio. We need to have another profit sharing ratio. Now, how do we determine the profit sharing ratio? This is a matter of understanding how much that would cause you to of dilution. If you're not willing to give a lot, for that portion, then the profit sharing ratio may be very low, less than 1% even. But if you're willing to give incentive for the investors for that profit, then it might be slightly higher. Can the modified SAFE be without profit sharing ratio and without discount? No, because that profit would only be enjoyed by the founders. And as we mentioned, any condition that would preclude one of the partners completely from profit is not allowed. So discount rate is an invalid way to share profit. Having no profit sharing ratio at all violates the principle of profit sharing. How can we determine the profit sharing ratio for the interval? This is technical. I mean, if you go to advisor, I mean, this is an industry practice, or like this is something that the industry would figure out, but it's similar to discount rate. There is no math. There is no fixed rule or principle that would allow you to come up with a discount rate. Similarly, you don't have any way to there's no rule that would give you that would let you reach to or arrive at a profit sharing ratio that is optimal. This is something that you need to analyze, see the numbers, and decide. For the interest of time, we're not going through this, but this is one method that you can determine what would be the method to determine or to choose or to agree upon a profit sharing ratio. Why do we think a profit sharing ratio is superior to discount rate? Because of two reasons. The first one is that discount rate is less predictable. If a founder faces a trigger event in a period when the company's growth is slow, then the discount rate will be devastating for pre-SAFE owners. Remember the example where, even though it's an example, but it would, if the numbers are large enough, then the impact would be significant. SAFE discount rate, if the profit is limited, even though it's big, then the discount rate might preclude the founders from any capital gain, and the capital gain would be completely owned by the SAFE investors, and that's why it's less predictable. Profit sharing ratio correlates with the firm performance. Why is that? In simple terms, what we are saying that any amount above the capital contribution, above 2 million, we would share it based on a profit sharing ratio. So if that amount is 10K and we agree that the profit sharing ratio is 10% to 90, then the investor would get 1K. So it matches or it correlates with the performance. If it's 10 million and it's still 10 to 90, then the investor will get 1 million. So it is more predictable and it correlates with the firm's performance. Now, just to bring everything together, we will run an example with 3 different scenarios of SAFE. The features will be the same. The investment amount is 1 million. The valuation cap is 10 million. Discount rate is 20 million. This is for comparison. And the profit sharing ratio is 3.125% for the investors. And the current book value is 1 million. Now, in the first example, the future value of the company is 750K. In one of the trigger events, we determined that. Now, in ordinary shares, the basis for the ownership would be the fixed valuation, and in this case, the investor would be entitled to 75K. In SAFE investor, the basis would be a liquidation preference, and they would get everything, 750K. In SAFEi, the basis for sharing the proceeds would be the capital contribution ratio, and it would be 50%. That amount to 375K. So this is the first scenario. Second scenario, the company is acquired for 9 million. 9 million is below the valuation cap, above the capital contribution ratio. If the investor came in using ordinary shares, they will own 10%. I mean, from the get-go, from the moment they sign the ordinary shares, they will own 10%, and that would amount, in the case of acquisition, to 900K. In conventional SAFE, using discount, we use the formula for discount, and we arrive at an equity amounting to 13.51%, and that would, in terms of dollar value, it's 1.2 million. Now, in SAFEi, we use a profit sharing ratio. And notice that even though we use the profit sharing ratio, we arrived at a similar number. So remember, we have 2 deviations from the conventional SAFE. The first one is this one, the capital contribution ratio, and this is its impact. The second one is the profit sharing ratio, and this is its impact. And as you can see, the impact is not significant, but it addresses the Sharia issue. The third situation, when the company is priced at a equity financing at 30 million, which is above the 10 million. You see here the formula for ordinary shares. If the contract was ordinary shares, then they will still get only 10%, 1.3%, amounting to 1.3 million. If it's a conventional SAFE, it will still be using the valuation cap. They will get 10%, 1.3 million. If it is a SAFE, the alternative version of SAFE, they would still also get the same number. And why is that? Remember, we mentioned that the profit above the valuation cap in conventional SAFE has an embedded profit sharing ratio without explicitly mentioning that. And in our alternative, we don't have to mention that because it is embedded. What matters is the essence of the requirement and not the wording. Not having, you don't have to say the profit sharing ratio is 10 million. Saying that you're investing this amount, X amount, and the valuation cap is X amount would tell us what is the profit sharing ratio for the profit above the valuation cap. Notice that discount rate and BSR are not considered when future valuation is above valuation cap. Other related discussions would be how future safe investments in the alternative version would come in, the pro rata rights, the employees stock option increase that would come with the price round, and so on. The lack of maturity date, the way to divide dividends. These are not necessarily issues, but they are point of discussions. Lastly, how can a founder investor fix safe note? Firstly, understand the problem, the lack of defined ownership. And as we mentioned, basically the liquidation preference that stems from the lack of or the ambiguity that relates to ownership. Then understand the impact of the alternative in economic terms, the capital contribution ratio and profit sharing ratio. If you understand the impact, you wouldn't be, as an investor, afraid of adopting these terms. And you would actually appreciate these terms because they are fairer than the conventional terms. Capital contribution ratio, we mentioned that it doesn't deprive the founders completely from proceeds. And the profit sharing ratio, we mentioned that it correlates with the company performance, unlike discount rate. After that, you modify the legal agreement, and you do all of this guided by a Sharia advisor, an expert in this field. With this, I end my session. I think we will take some insight from other speakers, and then we will be open for questions and discussion.
All right, Jazakallah khairan kathiran, Brother Sheikh Mishal, right, for that very technical and comprehensive discussion on safe agreements, right? You've highlighted a heavy load of, challenges, propositions, right? I'm not going to begin to try to summarize everything. There's a lot that has been said, right? As you mentioned, right, we do need to get to the Q&A session. But before we do so, we have other well-versed and, well-acclaimed individuals with us today. So we want to hear from them as well, right? I think next up, we have a very special brother who's been in the industry for beyond a decade, right? He requires no introduction. But I see one hand up, Brother Abdul Jalil. Right, inshallah, as I mentioned, we will get to the Q&A session. Yes, we will get to the Q&A session, so please be patient. Whatever question you have, please jot it down so you don't forget it. All right, Jazakallah khairan akhi. So as I was mentioning, right, we have a very renowned brother in the field of Islamic finance, right? If you are in the space of fintech and you haven't heard his name, then welcome back to planet Earth, right? He is none other than Umar Munshi, the managing partner of HASAN VC and the co-founder of Ethis Global, right? I believe he's here with us. Brother Munshi, are you here?
Yes.
Wonderful. Okay. So the question I have for you is as follows, right? As a leading figure in the Sharia-compliant venture capital space, right? What are your thoughts on safe agreements, right? More specifically, let me say, what do you think are the key challenges faced by startups seeking the seed funding, right? The SAFE. And do you think there are any alternatives do you think any of the alternatives proposed by Brother Mishal or perhaps any other alternatives that are viable, right? And perhaps you could, share some of your personal experiences on the subject along the way, right? Over to you.
Right. Thank you, Sano, for those questions, and thank you to Adel as well for inviting me. So first of all, I just want to maybe comment a little bit on this session itself. I think we've covered quite a lot just now. Brother Mishal, mashallah, he went through quite deep and into many different issues, many different considerations. And I think my view, the spirit of at which I'm taking, for me, I'm approaching this session is it's a very important step. Right? I don't think there's anything that in a sense will be final today, because it's something that it's an ongoing process, right? What I mean by that is the startup world itself is in a state of change. The Islamic finance world is, the Muslim world is getting more involved in the fintech, in the venture capital space, in the angel investment space. And this topic is something that I think, unfortunately has not seen much discussion, although it's a very significant topic in my view, because the default today, in general, the default for most early stage startups will be to go for a SAFE, right? Because that is generally what you find if you were to do a random search online on how to raise funds as an early stage company or founder, right? So that has become in many cases a default approach, and because on the surface it probably seems like a safe is safe, right? There's nothing, it may seem to be having no elements of things that are haram or things that are not in line with the principles of Islamic finance. So even very practicing or very conscious Muslim founders may assume that it's all is good and fine, right? So yeah, I just wanted to start off with that point that I believe today's session is a very good step, and definitely there will be more steps, both in terms of discussions and research and exploration, as well as implementation. Having a precedences of alternative safes or iSafes being signed off or being implemented in the market. Because I think right now there's probably not many actual incidences or circumstances of that happening, right? Because even the safe itself, as an instrument, when it first came out many years ago, I don't know when, but a long time ago, and it became so popular. Only after some time, then some of the, I guess, potential drawbacks or shortcomings of that approach became, more obvious or became known, right? Because only when you actually implement something, then you will, face the situations that test whether that theory and that approach actually makes sense or will work out the way it was intended, right? Yeah. So back to today's session, as I mentioned, my view is this is a very important stepping stone or step, and there will need to be future discussions and definitely the implementation part. So for HASAN VC, just putting on the head of our venture capital and accelerator firm, we currently go for price rounds, fixed, valuations, right? That means we agree on a early stage valuation and we go for it, and then we share in whatever upside or downside of our portfolio companies. And the reason we've done that is because of the uncertainty around SAFE in that sense. When I say uncertainty, Brother Mishal and Adil have been clear in what's permissible, what's dubious, or what needs to be avoided. Right? So I'm not talking about that in terms of clarity. What I mean is, because there has been little to no precedence of implementing this, we currently don't go for it in terms of an ISAFE, because we're not sure how it will be received by both sides, the investors and the startups. Yeah, so that is a very, very important step that we hope to work closely with Adil to explore, having this possibility of actually executing ISAFEs. Right now, for those who are not familiar, for HASAN VC, we are a new VC, and we're just about to start deploying or investing into our first batch of startups. And at this stage, what we've done is we have a fixed offer, a fixed valuation, so we don't actually discuss or debate about valuation, right? And that's something that Brother Misha highlighted from the beginning. It's very tricky to talk about valuations at any time, and especially today, right? Because the VC market is in a state of change. And so we have come up with our terms, for those who go through our accelerator and trying to get investment from us. We've fixed the terms, fixed the valuation. If you like our terms, you like our valuation, you come to our program, there's a chance we will invest in you. Because we know it's just so tricky to debate or discuss about early stage valuations, and we felt that it was not yet time to bring the iSafe to life. Yeah, so maybe I'll pause there and I'll pass it back to you. And happy to share more, later on as we go through this conversation. Thank you.
All right, thank you very much, Brother Umar, for that very insightful talk. Right, I'm sure there's a lot of questions that will be coming your way in regards to what those terms are, right? That you're proposing to startup seeking funding, right? So move on to the next speaker, right? The CEO and co-founder of Stecs, right, which is a fintech firm, basically offering non-digital banking services, right, through a mobile app, right? So the question we have for you, Brother Habeeb Gbenle, right, is what can you tell us about safe agreements in relation to the challenges faced by startups, whether your own company Stecs, right? And thereafter, what are your comments on the propositions that were either laid out by Brother Mishal or other alternatives that you have seen out there in the market? Is there anything better than Safe, or is Safe the best option? And if you could do so through your personal experiences, that would be obviously much appreciated, right? Over to you, brother.
Okay, thank you very much. Assalamu alaikum warahmatullahi wabarakatuh. I'm also very honored to be amongst these distinguished and speakers, and alhamdulillah that we are here to discuss this particular issue around safe or even startup investing, because as an operator, I like to put it that way, it's very challenging. But before going down there, normally for any founder or anyone that's coming to a position of trying to raise funds, we all know that it's very, very difficult raising funds, whether you have the best idea or not. More so, I would like to speak in the context of Africa. I think, like Umar Munshi mentioned, there is a change currently ongoing in the startup investment world. And based on statistics from last year, funding that went into Africa reduced by about 39%. And this is a region whereby we don't even have enough funding, right? And because of the issue from the US, increment in treasury rates, a lot of investors prefer to invest in debt instruments than pour money into startups. And in the past 7-10 years, the percentage of foreign capital into Africa is about 80-90% compared to even local capital. So coming from an operator that is also now building in the ethical finance or Shariah-Compliant space, you can see how more difficult that is. However, when it comes to our own personal experience in getting as an operator, because at some point we need to raise funds, of course, the first challenge was which instrument are we going to use in raising these funds, even while speaking with angel investors. So we had a lot of, search. We were able to come up with a convertible note, which has a loan note, which is covered, and a promise to issue shares. And we presented this to our Sharia board, but they turned it down due to what Brother Mishal had, explained while giving his presentation, that, every loan that comes with benefits is riba. Even though in our quest to try to convince the Sharia board that, we had other Sharia scholars that admitted this, but because we could not go against our Sharia board, which is also very important, we were trying to see how we could convince them, but they still held their position that it's better to look for an alternative than to go with the, in quotes, the instrument that mirrors a convertible note, which is a loan note and a promise to issue shares. And even in the conversation we had, the resolution was we should look for an alternative that has a more partnership mode. But it was difficult figuring out all the complexities. And it was at that point we got to meet the Adler advisory team, to, discuss more on the SAFEi instruments, which in our own assessment is still ongoing. It seems a very plausible alternative than any we've seen out there. And if we're even going to compare it with the conventional SAFE, it just makes perfect sense, because being an VC associate, as VC tries to look at the upside. In most issues, they look at the upside, because when they invest, because then the model is spray and pray. That's what we call it. So you invest to as many startups as possible, hoping that the returns from 2 or 3 of those investments will cover up for the losses. So the VC inherently know that all these startups will not be successful. So they focus more on the upside. And if you look at what Brother Mishal presented, the upside, when we look at the upside, which is if the equity or priced round is above the valuation cap, it's the same. It's the same. So that makes it a lot interesting for investors, even those from the conventional end. Second is when it comes to investment or even credits, issue arises when there is a problem, when you are not able to pay back, or when there is a down round in this case. And if you look at it, the down round, even though it might not necessarily favor the investor when we compare it with the conventional SAFE, it just still makes sense. It promotes some level of fairness and transparency. And I'll give an example. When I was in the VC space then, there was a founder that got, it was in the print industry, right? And I remember then when we do portfolio meetings, he would say, oh, one of his exit strategy is to get acquired by one of the top firms in the industry they play in. And lo and behold, that was about to happen. They got interest from that industry leader. But due to some covenants and some clauses in the investment agreements, the investor could not invest. And the founder almost got into depression, right? These are some of the unfair terms that you find in some of these conventional notes. And most founders don't know this until maybe there's a bigger opportunity or maybe there's a down round. Giving another example, there was an example of a founder that sold his startup for about $12 million. But guess what? He did not receive a dime due to these liquidation preferences that Brother Mishal talked about. So if you look at it holistically, the SAFEi makes a whole lot of sense from the upside and from the downside, noting that investors majorly focus on the upside. So that's been my experience thus far, and I would like to stop here in case there are more questions. Thank you. Sano,
all right. Yes. All right. Thank you very much, Brother Habeeb, for those wonderful insights. Your personal experiences are highly appreciated. All right. So that concludes the presentation, right, by our speakers, right? I think it's time now to open up the floor to the awesome participants who have been very patiently waiting for you guys. All right, so the number as it stands is that, let me put this on full screen. It says here 51 participants, right? This is obviously including the speakers and myself. So let's say -5, we bring it down to around 45 individuals over here, right? So people have been posting questions, right, since the beginning of this session. I will try my best to go through the ones that have been written, right? But obviously the preference would be given to those who have their questions readily, and they want to perhaps unmute themselves and ask their questions, right? So while that is going on, in between, I will read some of these questions, right? So if anyone has a question, please just raise your hand, right? There's a button somewhere on the screen where you can raise your hands, or just unmute yourself, introduce yourself, your name, the company you're representing, or your designation essentially, and ask your question. All right, while that is happening, I'm going to find the questions in the chat.
Assalamu alaikum.
Wa alaikum assalam wa barakatuh. Yes, who is this?
Okay, so my name is Dr. Abdul Jalil Ibrahim.
Dr. Abdul Jalil, marhaban. Okay.
I'm reaching out to you currently in Ghana.
Ghana,
and I would like to thank Adel for this initiative because for me, I think it's very, very important for the startup ecosystem within the Muslim world and even beyond. I have two questions. I don't know whether maybe what I can do is to actually I have many questions. I'll just try to ask few, and later I can send an email on the other
That would be
issues I
wonderful.
have.
Yeah.
We
Please.
can continue the discussion.
If I may ask, brother, please let's try our best to keep it concise, right? I'm sure we have a lot of questions people want to ask. So please, brother, try your best to keep it concise. Yeah, much appreciated.
That's right. Okay, so maybe I'll just ask only one question. The rest I'll send an email. So if you look at it's a very good proposal from Adel. But what I want to know is that in terms of the valuation, if let's say you are going to value the company based on the book value of the startup, we all know that it's difficult to value startups at the initial stages, and most of the time the most important value from a startup is the idea. So if you are going to value, let's say, the startup and say, okay, let's say I want to raise 1 million, then the investor will also bring, let's say, so you value the company 1 million, investor will bring 1 million, 2 million. So how do you, in terms of practical, how do you value the startup to be able to determine the value, and the investor will, let's say, maybe do the co-investment? Because I think it's extremely important for us to have a discussion around that, because I think practically it's difficult. And that's why usually in the SAFE agreement, they look at, okay, future value, they do the valuation cap, because things are not certain. There are a lot of ambiguity and all that. So how do you go around this valuation if you want to do, let's say, maybe the net book value? Because startup, you don't have any assets. Usually, maybe if you're going to value, you value based on wages of the founders and maybe some technical people, which usually will be very, very small. So how do you value the idea or the startup valuation practically to be able to start an investor? So that's my first question.
Okay,
so maybe I'll leave it at that. Yeah, I'll leave it at that.
Okay, thank you very much. Yeah, thank you so much, brother. We will the contact, right? The email is available in the chat. It should be available. If it's not, we'll have it up right away. Inshallah, you can post all your questions over there, and it'll be answered accordingly. Okay, so in regards to your question, I think it's very clear. Right. The question he was asking is how, with all the ambiguity within the industry in terms of what a company is really worth, right? As you pointed out, Sheikh Mishal, right? There's so much ambiguity. What is the solution, right, to valuing companies, right, or startups, right, that are acquiring seed funding? How do we value these companies?
Thank you for the good question, Dr. Abdul Jalil. Now, remember what we meant when we used book value as a reference for the valuation. We're not referring to a final valuation. We're not issuing equity based on this valuation, because it wouldn't make sense at all to issue equity or to imagine that a founder would accept such valuation method to value their company. And we mentioned also in the slides that valuation, book value is one of the way to value a company for the purpose of calculating the capital contribution of the founders. Now we want to give a value, to assign a value to you as a founder or to the founder to as your capital contribution. Remember that we're not issuing equity, because if we issue equity, then we need to have consideration to the possibility that your startup will shoot, and because of this, you'll most likely startup founders will require or demand a very high valuation for their company, and they believe that their company will reach that valuation in the future. We're not discussing that valuation. That valuation we use the valuation cap for, and it solves that issue. We're discussing the valuation that we would be using to share losses, basically to determine what constitutes capital. So book value is one method. If it doesn't suit your company, for example, it might suit a manufacturing company, but as you mentioned, like a fintech or startups in general, your assets are generally your ideas, your software. It might not have a significant book value. So in this case, you might have any valuation that you think is fair and would be acceptable as a value for your capital contribution. But we mentioned a couple of other evaluation method, and one of them is cost to duplicate, and this would make sense in terms of coming up with a value for capital contribution to your to startups. So cost to duplicate, for example, you spent about 200 or 300K up to now, or not you spent. If I want to duplicate your company, to duplicate Stecs, let's say, I need to spend 1.5 million to just reach the current status of Stecs. Then I would value Stecs, I would value my contribution as a founder at 1.5 million. And then the investor comes in 1 million. And then we would have this capital contribution ratio. Do we get diluted by this valuation? No, because we don't issue equity. What is the effect? The impact of this valuation is a way to determine how we would share losses. Any future valuation that falls below the total capital contribution of both the investors and the founders would amount to a loss and would be shared pro rata that capital contribution ratio. I hope it was clear.
Jazakallah khairan, Brother Mishal. Right, I think to concise what you were saying, just to simplify it, right, from what I understood humbly, is the cost duplicate method, right? As you gave the example of Stecs, how much funds would it take to, establish Stecs at the current level that it is right now, and that amount would constitute the valuation, right? I would like to bring in Brother Umar, right, if he's still here, right? He mentioned earlier about the terms, right, that are presented to startups, right, that are seeking funding, right? Do you have anything to say on how you value? Perhaps you want to share something on the terms.
Sorry, Sano, can you repeat which terms are you referring to in general? Or?
Yeah, Dr. Abdul Jalil was asking, how do you value a startup? Like, what mechanism do you use, right, to value startups? So you mentioned earlier something about the terms that you present to these startups. If they accept the terms, cool. If they don't accept it, then tasrihum bi ihsan, right? You guys would part ways with no hard feelings, right? So how do you, as a venture capital, value startups? And I believe that's the question Dr. Abdul Jalil was asking. Sheikh Mishal has mentioned something about the cost duplicate, right, of how much funds it would take to essentially form a particular startup at the stage it is currently at, right? That would constitute the value of a startup. So yeah, do you have anything to add on that before we move on?
Sure. So there are many methods and approaches that all come together typically, and different investors will have different preferences or weightages on different methods, right? But there's the scientific method in general where it's based on financial projections, assumptions, and so on. Of course, while we can consider that to be scientific based on numbers, but it's also highly subjective because it's based on projections, right? So an overconfident founder, will end up with a higher valuation than somebody who's more conservative, right? So, but that is I guess one of the standard ways. But practically, at the end of the day, it is putting on the founder's hat as well. It's about the founder, what the founder is willing or able to give, which is, especially today, very much influenced by what's happening around us. And again, there's another gap because some founders are still stuck in the VC boom. There are still founders and companies that come with crazy valuations, which maybe 3 years ago, 5 years ago was maybe still possible, although it was never easy to get that kind of valuation. But today it's just not logical anymore. So the founder's willingness or the offer of the founder or the founder's basically preference or willingness to give shares, I think that is one part of it, which then needs to be balanced with the VC's appetite, right? So it's essentially an offer acceptance negotiation kind of arrangement or situation. For us, as I mentioned, we avoid that by having standard terms for investment. And for us, we're able to do that because we invest in a very structured way where startups go through our accelerator program. And in summary, we invest $60,000 per company. It's meant for pre-seed, early stage companies, although we also have some more mature ones. And for that $60,000, we take 7% equity plus 3% advisory shares. Right? So we basically benchmark. We want to invest in companies that are around this valuation, right? So if you feel that this is within your comfort range and you see value in us being your investor, then join our program. And then we go through the process to see whether eventually you're one of those companies that we offer to invest in, right? But back to your earlier point, how does valuation happen? While there's the scientific calculation way is also subjective. I think at the end of the day, it really depends on what the market is like, what the sentiment is at different points in time, different segments of the tech world or startup world is more in demand, is sexier, is trendier, right? A few years ago, some maybe crypto projects were probably be very, very high valued, and then went down. Now it seems to be going up again. Things like AI. So it's a lot of factors. There's no easy way to answer that question. But I guess one way you can try to do it, especially if you're early stage, is to go through programs and accelerators like what we have. Right? Other than that, is just looking at the market and trying to see what's actually happening in the market. What kind of prices or valuations are being accepted by investors.
Okay. All right. Thank you very much for that insight. I think if I had to summarize that in one sentence, would be confidence is key. All right. You as a founder, right? You need to come in with not too much arrogance, not too much humility. Just come in with some level of confidence and present your case. Right? Maybe hit the table once or twice. That might work. It might not work. What do I know? All right. Move on to the next question. We have a brother who has had his hands up for quite some time. Brother Taha, right? If you are available to speak, please unmute yourself and pose your question. And please keep it concise, brother. Much appreciated.
Sure. Jazakumullah khairan. Thank you very much for the excellent intervention from all the intervenants. Barakallahu fikum. I have two very small questions. One is there any standardization effort from AWIFI on the SAFE? And second question, is there a more broader effort that is being made, kind of international collaboration to be made between, Malaysia, Indonesia ecosystem, the US Muslim ecosystem, and European ecosystem, for instance, in Africa that we just mentioned as well with the other brothers? Thank you very much. Jazakumullah khairan.
Okay, so you're asking in terms of the valuation mechanism or like an international effort to standardize the valuation mechanism? Is that the question you're asking?
I think the brother is asking about the standardization of SAFE itself. Perhaps I can take I can take it, and then I think Brother Umar can also add to it. Yeah, I think it's a very pertinent question, and thank you for asking this. At Adil Advisory, Alhamdulillah, we have been working on this version of the SAFE for quite some time. I would say more than 2 years now, Alhamdulillah. And I think I saw one question also from some others as well, asking if we have a detailed Excel sheet and everything. So I just want to assure that, alhamdulillah, yes, we have very, very detailed internal mechanism. And what Brother Mishal presented is basically a high level of it. So what we do is we take into the different contexts that the investors or the founders have, and then accommodate into our internal workings. And based on that, once agreed upon, then we tweak the agreements. We help tweaking the agreements. Now, the question, let me go back to the question. The question was, is there any international effort? So what I can say in this case, standardization usually comes in when things become very, very popular and there is a very wide range of practices. So far, I'm not aware of any such standardization processes with international standardizing bodies. However, alhamdulillah, we know of our colleagues, different Sharia advisory companies around the globe, from the Middle East, from the West, are also advising the the founders, the investors on coming up with a Sharia-compliant SAFE agreement. There are different approaches. We respect all of them. But now the next question that you asked is would there be any such effort, or is there any such effort to make it internationally known? So I think you are the brothers and sisters who can take this forward. We did our working, it's ready. And alhamdulillah, we have already advised a number of founders, companies from different parts of the world. We also have a few requests coming up to us since we have mentioned about this webinar. People have reached out to it. So we are scheduling the calls with the founders. But if you are, if you want to take this to a community of founders, we are very, very happy. And alhamdulillah, that's what HASAN VC under the leadership of Brother Umar Munshi as well as Brother Habeeb are also doing it. So we will be very, very appreciating it if you want to take, and we are open for that. If Brother Umar or Brother Habeeb, you want to add anything to it, please feel free. Thank you.
Okay, let me go first. I think when it comes to standardization, I would say just like the conventional, I think SAFE became very popular today because it was developed by an accelerator that is globally known and have a track record for investing quite a sizable amount in potentially the best startups in the world. And I also see the same thing if we need to make this SAFE more prevalent, which is we need more Islamic VCs and PE. And let me use this opportunity to say, perhaps criticism are good, but I think we should reduce our criticism of the Islamic banks because they are out there to solve certain problems. And if we are clamoring for a more partnership kind of financing, then it means we need to have more private equity firms and venture capital firms, or even accelerators, right? In fact, we should have more Islamic accelerators than even the conventional, because the mode of financing conforms more to the Shirika model, which everyone tries to amplify when it comes to Islamic finance. So I think until that begins to happen, it might be very difficult for SAFEi to be more standardized and more prevalent. So this is a call out to potential investors, industry stakeholders, to come up with more structures, more accelerators like what Brother Umar is doing in Southeast Asia and the GCC with HASAN VC. In Africa here, we don't have any. There are more coming up, or people are about to start. So until we begin to have those kind of structures, and not necessarily wanting to start a conventional Islamic bank and an Islamic bank, or more of a VC accelerator or private equity firm, I think we'll begin to have more people embrace this kind of instruments, and it will get to the conventional part too. And to be honest, there's a whole lot of good in that. And as humans, when we see good in something, naturally we'll be inclined towards it. So I think that will be my own position on that. Thank you.
All right. Thank you very much, Brother Habeeb. Mr. Munshi, Brother Munshi, you had anything to add on that?
Sure. I think just touching on the other point by Brother Taha about collaboration and synergy with other regions, other communities. So I think for HASAN, we from day one we that's front and center our priority to see how best and how quickly we can try to pull in others and also support others and work together with people in different parts of the world. And whatever we're doing now in HASAN, just to share with everybody here, is meant to be something that can be duplicated and also implemented in other countries and regions with partners and collaborators. So including this concept of the SAFE, as we move forward, we will learn, because there's very little precedence in the halal or Islamic finance space for VC. So we are learning as we go, and whatever we learn, we want to document and pay it forward and share it with anybody else who wants to work with us in other parts of the world, inshallah. Yeah.
Okay. All right. Thank you very much, Brother Munshi. Okay. So there's someone with the name of. Let me ensure I have the name correctly mentioned. Is it Sharif? Let me just confirm. It's very important. Is it Sharif? Is it Sharif? Yes. Yes. Sharif Rafi. Right. He's been asking a number of questions. Right. For example, when do you foresee a Sharia-compliant edition of SAFE when do you see that, right, becoming prevalent in the market, right? And then the follow-up question is, what can we do to speed up the uptake of its prevalence, right? Now, Brother Habeeb mentioned something about how we need to have more VCs, right? Sharia-compliant VCs, more Islamic banks to support, these startups, right? Particularly those, in the African region and other regions of the world that are developing or underdeveloped, right? So, yes, over to the panel. You guys have anything to add on top of that? Right. Is the question clear, right? A Sharia-compliant edition of SAFE, when do we see it becoming more prevalent in the market?
Yeah, I think my earlier comment speaks majorly to that question. We just need more players willing to come up with more VCs and PE or even accelerators, right? I would say for early stage, accelerator is the way to go, just like HASAN VC. I think it would be a more probable model than then. Also good to have VCs and PE, because one of the reasons startup fail, part of the reason startup fail is because lack of funding is part of it. And if we don't have enough capital injected at the very early stages, it will be difficult to support these startups to get to maybe later stages where to be more attractive to the private equity firm and even VCs, because in the startup funding process, you most likely want to use your personal savings or family and friends. Then you speak with angel investors, right? After that, you want to speak with institutional VCs. So having more of HASAN VC would really, really do a lot of good. Right? Of course, we focus on Sharia-compliant. And using these terms gradually, if this happens, I think gradually naturally begin to see people adopting these kind of instruments, because we now have more players in the industry. So that will be my own.
Yeah, if I add a bit to what Brother Habeeb mentioned, I think as a founder, what you can do is you can have the conversation with your investor that we want to adopt a Sharia-compliant version of it. And what would that do is that would serve your interest that you're looking at to defer the actual valuation for logical reasons. But at the same time, it will also help us maintain our faith and the compliance. Because the way that we designed, as we have seen from the presentation of Brother Mishal, the outcomes are very close, while we ensure that it's more fair, it's more just to the parties, and it basically covers a lot of different scenarios. So I think the first step is conversation on a very individual founder level. But then, as I mentioned in the earlier response as well, if you are within a startup community or you're heading a startup community, we would be very, very grateful to collaborate and see how we can synergize and share the versions and see the work forward. I think the initiatives are the one that would take it forward. In case of Y Combinator, for example, how did it become popular? Because they have this accelerator program, they have these founders and its investors putting the trust on them and using it. So we have to use it. When we start using it, the confidence will grow and we'll see more and more startups doing that. But again, I want to also add a disclaimer that the purpose of this webinar is to just convey the message that, alhamdulillah, there is an alternative. If you are resorting to SAFE for whatever reason, then there is an alternative that you can also do it in a Sharia-compliant manner. But we are not saying that this is the best instrument. There could be various reasons and circumstances that SAFE is using. But if you have a more better approach, for example, that Brother Umar Munshi mentioned, in case of HASAN VC, they're going for a agreed upon valuation and directly going for an ordinary share, which is much, much cleaner, right? So I think the approach that a VC or a startup or founder or investor should take is based on the circumstances. They would look for the best way possible. But at the same time, what we are stressing upon again and again, that we don't compromise on Sharia compliance for whatever reason, because there are now alternatives. Things have been worked out, and we are ready to move forward with the Sharia compliant version. Thank you.
Maybe I can.
Yes, please. Further.
So I think adoption of anything new in an investment world, it can take time, right? There's inertia towards change. But we believe actually at HASAN that now is probably a very good time for this to happen, for this to be introduced, because there's globally a lot more awareness about Islam today. There's a lot more appreciation about the faith, among Muslims, right? And also, there's this, we consider it a mini boom in halal startups, right? And we see conventional VCs investing in this space. So while there is inertia, definitely it's not easy to just implement something new like this, new in the sense of the structure. But I think it's a good time, as good a time as any, right? And I have a solution that you can try. Maybe the straightforward solution is for Adil to approach Y Combinator and tell them, look, we got an improved version of the SAFE, which is more inclusive, and more diverse, that can fulfill the Muslim requirements. Yeah. Thank you.
Very good suggestion.
Yes.
I would like to add something.
Yes,
so,
okay. We'll just try to keep it. Okay. Yes.
So Yousuf said, I think for startups, I think one way to go about this is also do due diligence on investors. So you might not want to go for investors that are perhaps using conventional SAFE. Of course, the first is to maybe have that conversation, but maybe look for accelerators or investors that would ordinarily just take equity. That's a lot more cleaner. And I think at that point, it's easier to even, talk about some of the terms in the equity agreement that might not necessarily be compliant. So that might be another way to look at it. So due diligence on the founders or startups part too would also be very helpful. But more importantly, talk about these alternatives, right? And gradually that could also maybe increase the awareness about these kind of alternatives.
All right, much appreciated. Thank you very much, guys, for that very unpacking that question, collectively and comprehensively. We'll end it with one more question, and I think the best of questions are those that are provocative, right? So I think this question is for Sheikh Mishal, right? Sharif, same brother is asking the question, right? Why do you call a priced round that triggers conversion below a valuation cap a down round when no prior valuation has been set, right? And then the person rephrases the question stating, there's no prior valuation prior to the price down to even contrast to as a down round. Essentially, why are you calling it a down round when no valuation has happened? That's the question. Why, brother? Why?
Brother Sharif is correct. Technically, it's not a down round. It is. I'm just saying that it's a protection from. It might be. I mean, it has the same effect of having a down round if it was a fixed valuation. But technically, Brother Sharif is correct.
Okay, that's a very honest answer, mashallah, tabarakallah. All right. Brother Sharif says, I can sleep well tonight. Good response, Brother Sharif. Okay, so there are a number of other questions that people want to ask. Brother Mustafa Abu Bakr, I see over here, he has his hand raised. Unfortunately, we do have to respect time, just as we do respect the Brother Mustafa, right? And all the other questions that have been posed. I do apologize for overlooking any, if I have, especially the ones who posted it much earlier. Jazakallahu khairan kathiran to the esteemed panel, the distinguished guests, right? This today was a very insightful, very heavily loaded session. Phenomenal questions. Mufti has his hands up. Mufti, you have a question to ask?
Another question. I just wanted to, I saw a number of queries, for example, will we share a template or something? So I just wanted to give a disclaimer.
Yes, please.
Yes, because please. It's a legal document, we don't have a version of it per se. What we do is, if you already have agreed upon some terms based on the Y Combinator version, then we take it further. We have conversation with you or maybe the investor. We understand the expectations from both ends, and we suggest the best alternative. And accordingly, we customize the agreement. But again, we gave us a disclaimer that we are not lawyers. So depending on the jurisdiction you're coming from, you should have the final vet from your lawyer. So that's how the modus operandi at other days. So we highly encourage, if you're a founder, if you're an investor, you are interested to have further conversation, please knock us. We can have a conversation for free, no worries, inshallah. And when we go for a professional step forward, we can discuss, and I can assure that the way at Adel that we work is more like a startup, even though we are shared advisory company, but we see ourselves as a startup as well, in terms of agility, in terms of price efficiency, in terms of speed and turnaround times as well, inshallah. So please give a heads up to our email or LinkedIn message as shared in the chat box, or you can reach out to me personally as well, or Brother Mishal. We are available in LinkedIn as well. And we'll be happy to connect with you and have the conversation, inshallah. But we don't have a template or a version of the document per se, as Y Combinator and others have it. Jazakumullah khairan.
All right, Jazakallah khairan, Mufti, for that. I think there's nothing more to add on top of that. Just aside from thank you to the esteemed panel, right? The participants as well who have been present throughout, and those who came in halfway through, or those who came in to just peek, right? To see the beautiful faces before us over here. Thank you all once more. As mentioned by Mufti, if you have any queries towards Adel Advisory, right, the email as well as the contact essentially is available in the chat box. So this would be a good time to take a screenshot or to copy it, basically, right? Otherwise, it's actually not that difficult to find. You could just Google Adel Advisory and the email will just pop up there, right? Hopefully you see me as well, somewhere there. All right, with that, thank you very much to the contributors as well. Our dear brother Umar, right, from Ethis Global / HASAN VC. We have our brother Habeeb as well from Stecs. And yeah, with that, on behalf of Adel Advisory and everyone else, Jazakumullah khairan. Thank you guys very much for joining us. I don't know, are we taking a group picture? Or, right? I have never been the one to propose it, right? But I think let's do it this time and see how it goes. And based on it, I'll use it or not use it in the future sessions. All right. So, Brother Anas is here, I believe, right? Brother Anas.
I think we can ask everyone to start the video. We have enabled for everyone.
Okay, that's a good idea. All right, this would be a good time to turn on the lights in the room. Okay, so I'll do the countdown. Yeah, whoever's taking it, so everyone is ready. All right, 3, 2, 1. One more time. 3, 2, 1. All right, we'll assume the photo was taken. All right, thank you all. Everyone have a wonderful week.